I hope everyone had a very Merry Christmas. I know I did, and I know it's a very important holiday for a lot of people, so hopefully it was a good one. I want to talk today about something that not a lot of people really go over with you, right? There's something in the market called first order thought, right? And I want you to remember that often in markets, the first thought you have is going to be wrong, right? And one of those thoughts that people often have is that stock market winners are about to fail, right? Like Nvidia or Apple, for instance. These stocks have done so well that they must be about to fail. This is really not a good way to think about stocks, and we'll go over why. Firstly, I want to talk about where we are for the year. Um, you can see we've had a spectacular year so far. We're at about 27%. You can see some sectors were over 30%. There was a few sectors that were flat, but every other sector had significant gains, other than real estate, which had low gains, and healthcare. Um, but this was a very good year for stocks. A lot of people think that portends a bad year next year. I don't think it does because we're in the middle of an artificial intelligence revolution, and the earnings from artificial intelligence are real, right? These aren't fugazi internet earnings far into the future that are supporting speculative valuations. These are the largest, most successful companies in the world, right? They they have advantages that other companies have never had before. The innovation ecosystem has changed so that one of the most sure ways to get to market is to get bought by a large tech company. And that's the end goal for a lot of smaller companies, right? And this creates a situation too where ideas are being shepherded under more mature supervision, and it really reduces the risk for everybody. So we live in a brave new economy, and one of the effects of that economy is that we've gotten some extreme stock market concentration. But before I dive into the concentration, there's one thing I want to point out that was very bullish today. We started out with a loss. We started out with a VIX spike up to plus 11%, and the Dow down well more than 100 points, and we came up with an intraday turnaround Thursday, we'll call it. So that's very positive for stocks, especially during the Santa Claus rally. To me, it means that Santa Claus is here and that the Santa Claus rally has begun. And I think the rest of the year will be very positive, as we've gone over in our earlier presentations and videos. So now let's dive into the concentration issue a little bit. My friend Matt Cerminero, from my former colleague from Fundstrat, did this chart for the compound. He does some of the best charts in the business, and I think it speaks volumes, right? But here's the thing about first order thought and second order thought. The first order thought response to this chart is, oh my gosh, look at how much of the market's value is concentrated in just 5 stocks, right? I should sell these immediately because it'll probably revert to normal soon. Again, we've been talking a little bit already about these companies' advantages. These are the most commercially sound companies in the world. They're essentially legal monopolies as well. Capitalism tends toward monopoly, and if it's legal and it's making money, that's good if you're a stock owner, unfortunately for the rest of the economy. But I will say this about the tech companies. They are very pro-consumer in their innovations, which does help mitigate some of the monopolistic tendencies. It shows you the level of dominance they have, and it helps explain why 5 stocks are half the market, right? When you consider what valuation means, it's more than just valuation. It's a vote on how likely a company is to make money in the future. And I'll put it very simply. These 5 companies are way more likely to be making money in 20 years, near or at levels that they are at now, than everybody in the left-hand side of this column, right? And that is why they enjoy such a hefty premium. You can see that market concentration has gone up quite a bit, but you can see it still doesn't exceed levels it was at during the 1960s. This is a really great report by Michael Mabusson. He wrote it back in January. It's called Concentration: How Much is Too Much? And if you are worried about concentration, I would read this report. I don't know how to put it, but we live in a winner-take-all world, and a lot of us learned that in kindergarten. When you are at the top of the commercial pile, you have a lot of levers to pull to keep yourself there. It's just a qualitative reality. And in the digital world with the networks that the big tech companies have, that is truer than it's ever been. Yet they still aren't more concentrated than the 1960s. You could make the argument that this concentration is problematic, but throughout most of history, the earnings have been also concentrated in a few big companies. And you can see this rise right here over the last 10 years. That is not without justification. As you can see here, in 2014, the earnings of the top 10 by market cap were very small compared to the rest of the market, right? In 2015, it begins to turn around here and it begins to exponentially change. And you can see in 2021, there was a big pop because of COVID and because these companies were able to continue earning because of the digital nature of their businesses. But you can see here still the proportion of total earnings made by just the top 10 companies has gone up dramatically. And the concentration is reflecting this fundamental reality. It's not reflecting undue market ebullience or a speculative nature. These companies have been delivering to shareholders for years now, through thick and thin, through the biggest crises of our lifetimes. And they employed the most talented people and most expensive people on earth. So, one of the things I like to think of the stock market as is a pretty beautiful thing because it allows us all to share in the good fortunes of the most capable among us, right? If you were to really spend time on what it takes to produce a 2 nanometer semiconductor chip, it would be a lot easier for you to not bet against these companies. Trust me. We did a trade of the week this week on Apple. Some people make fun of you if you have an idea on Apple. What we're trying to do is to use derivatives to get some of those higher returns that were capable in the past of Apple now, right? And there's a reason why we're going to talk about this tomorrow. There's a reason why people don't get you derivatives for Christmas presents because, it's a headache. A derivative is a headache. It's time dependent. You can be right and you can still lose money. There's all sorts of things that can go wrong. It provides consternation and anxiety. But let me tell you, this is also why the high returns are possible. You are being compensated for all of these things if you use derivatives properly. One of the ways we're using derivatives is we initiated a leap position on Apple, and we think that 2025 is going to be a very good year for Apple. We were very encouraged by Dan Ives upgrading his price target this morning. And, Apple is just, you can see here, it is just has a much bigger spread than its main competitors. And you can see that delivering to shareholders is worth something. Apple has a premium because it continually delivers to shareholders. And even though it might not be the center of all the AI-driven headlines right now, you can see it still has a bigger spread of its ROIC minus WACC, which is the most important fundamental metric there is in the stock market, in my opinion. So when I see a spread like this and I see an opportunity to get a relatively cheaply priced derivative that gives me price exposure to Apple for 1 year, I'm going to take that bet and I'm going to give my subscribers that bet. And that's what we did today. So for our subscribers, we hope you'll take us up on that Apple trade, and we'll give you a reassessment of it at the halfway mark of the year. But we think it should end in an auspicious fashion. Thank you for being with us. Happy holidays. We hope everybody's enjoying time with family and not thinking too much about the stock market. But we know there's that hopeless few that always will be. And for you guys, we are here. All right. Merry Christmas from Punk Rock Traders, and have a happy new year.